Hello, everyone. This is Gonzalo and Marc. And on this month's newsletter, we were providing you guys a high-level overview of the current 2022 multifamily national outlook, where things were and where we might be going this year. Marc, take it away.
Absolutely. Thanks, Gonzalo. So we have to start with the elephant in the room, which is the Fed. What the Fed does impacts us as real estate investors. Why does it matter? It affects your borrowing costs. It affects investor sentiment and many other factors that go into making a decision in the multifamily asset class. So the Fed right now, you can see Jerome Powell is walking on a tightrope. So inflation has ticked up. It's well above where their target is at 2%. And the labor market is very, very tight. So those are historically indicators that the Fed needs to tighten. And they've started with that. So this week, they've started by hiking rates 25 basis points on the short end. And they are forecasting that they may hike rates as many as 6 times in 2022. So why does that matter? Again, rates affect our ability to buy assets and at what level buying those assets makes sense. So by raising rates, they could potentially hamper demand for multifamily assets. Raising rates also runs a risk of potentially curbing demand throughout the wider economy. And that's something they definitely don't want to do, but is a risk. So again, they're walking a tightrope and it is not an envious position for them to be in. However, on the bright side, we still have to look at where we stand today versus historicals. Today, interest rates are lower than they have been. They're not the lowest they've been, but they're still lower than they have been historically. So it is still, from a rate standpoint, purely an attractive time to look at multifamily assets. Now, Gonzalo is going to talk about maybe some of the other factors that weigh into why we think multifamily is still attractive.
Thank you, Marc. So as multifamily investors, demographics is a very important topic that we need to better understand. What this graph here shows you age groups here of from 26 to 42-year-olds and the different phases of that age group. As you can tell, a large percentage of this age group is renters and will continue to be renters in the near future. An estimated 44 million people are going to be entering their 30s, the millennial group, over the next decade. And this stage is really associated with the family formation period, which includes growing households. And these people are going to be seeking larger accommodations in the form of perhaps going from a 1-bedroom to a 2-bedroom or a larger household or a single family. But due to the barriers to entry in ownership, these individuals, unfortunately, are going to be stuck in renting for many years to come. Accelerated household formation also increases, it's going to continue the absorption. And there's a record of 400,000 apartments that are slated to come online this year. And that 400,000 is completely going to be absorbed by the demand that's going to be there. This next graph basically shows the population group between the ages of 18 to 34 that are still living with their parents. 24 million of them living with their parents. And this basically shows a pent-up demand that is slowly being released into the marketplace in the years to come. And obviously this equates to a very huge demand because these individuals, more likely than not, will be renting. Therefore, providing a huge demand for apartments and clean, affordable apartments. And as mentioned in the previous slide, the 44 million millennials that have entered their 30s this year and are going to be continuing to start a family, it's going to basically require them to seek additional household, as mentioned. What this graph here shows is that the family formation is continuing to increase due to these individuals forming families. Currently, at the moment, housing supply is keeping up with that family formation, but if you see from previous years, specifically from 2010 to 2016, there was a huge imbalance of household formation versus what the supply was out there. Therefore, we have not caught up to the housing shortage from way back in those years. So this is going to likely continue to increase the demand of apartment rentals in the near future.
Yeah, and that demand supply imbalance historically, that supply demand debt, if you will, has been estimated to be as high as 4 to 5 million by the Freddie Mac federal agency. So that's a huge amount of demand that is, waiting still to be supplied.
And just to touch on one item there, the barriers to entry. I cannot stress this enough. Huge barriers to entry are going to be the headwinds for these individuals, specifically in the form of the price of medium homes is just skyrocketing, as well as just cost of living expenses. Therefore, these individuals, these 44 million individuals, unfortunately will be seeking to rent in the years to come. So on this next slide here, this is basically economics 101 related to demand, supply and demand. As the housing supply shrinks, the median home price index, obviously prices go up. So that graph is very straightforward as far as supply and demand goes.
Yeah, so how is this impacting local markets? And real estate is, after all, a localized asset class. While we talk about a lot of this stuff at the national level, it's important that we dig into the particular markets in which we're interested. And by looking at this chart, what you can see is that we're recovering. We're coming back from this kind of unprecedented period of 2020 when the housing market really was uncertain. And vacancy rates since then have come down in nearly every single major market across the US. Now, as the recovery gets underway, these recoveries are going to be uneven. So different markets are going to do better than others. And what you can see as a general point here is that secondary and tertiary, that is smaller markets in the South and Mountain West, are leading the recovery, while larger, mostly coastal and Midwestern cities are lagging in the speed of their recovery. That's reinforced by looking at the price performance just prior to the recession. So this is the period of 2019 to 2021. And what you can see is that prices have appreciated even prior to that point. And that means that, this trend was already in place going into the pandemic, but it was accelerated by the pandemic. Again, shifting the demand from the more gateway markets like New York, San Francisco, Los Angeles, to more secondary and tertiary markets throughout the South and Midwest. Now, that's also having an impact on rent growth, which is going up in those very same markets. And then finally, this is the 5-year forecast from Marcus Millichap as to where they think that the various markets will go in their next 5 years. And basically, it's a lot of the same. It's these same markets that we're talking about, these secondary and tertiary markets, warmer climates, lower cost of living, maybe a little bit more space. Your dollar goes a little bit further in these markets. Those are the ones that are going to most likely benefit in their view. And what does that mean for us as investors? Basically, investors are chasing the population. So you're seeing a lot more demand in secondary and tertiary markets over the last few years versus historically. And that's as a result of where the population is going, right? We as investors follow where the population is going. And that's clearly compressing cap rates in those markets. So finally, let's take a step back and say, what does this mean for the overall market and risk sentiment in multifamily? And if we look at this chart in the first half of 2022, this is a survey for multifamily apartment owners. And basically, there's still a very strong demand for multifamily assets, with 43% of owners saying that they would still be a net buyer of apartments, with a further 40% saying that they would hold, and just 17% of multifamily investors saying that there would be an overall sale on the asset class. So still a lot of demand for this asset.
All right, well, thanks, Mark. And as always, we hope you guys enjoyed this video and have a better understanding of where the multifamily sector might be going this year. So until next time, be kind, be charitable, and invest wisely.